Washington, in a stark reminder of the power of the bond market, investors have been sending a clear message to governments around the world. Reckless fiscal policies will not be tolerated. The so-called bond vigilantes have been flexing their muscles, exerting significant influence over policy decisions and leaving leaders like former British Prime Minister Liz Truss and U.S. President Donald Trump to reassess their economic agendas. The bond market, often viewed as a safe haven for investors, has been particularly volatile in recent years, with yields on 10-year U.S. Treasuries skyrocketing 49 basis points in 1 week, the most in over 2 decades. This surge in yields, which reflects the interest rates demanded by investors to buy government debt, has been driven in part by concerns over tariffs and trade policies. As one financial analyst noted, the bond market is very tricky and has a history of shaping policy decisions, with investors acting as a kind of banker for the government. The term bond vigilantes was coined by Ed Yardeni in the 1980s and refers to the collective actions of bond investors who sell their holdings and drive up interest rates in response to perceived fiscal irresponsibility. This phenomenon has been observed in various forms. From the early 1990s, when President Clinton's advisors warned him to maintain fiscal discipline to avoid upsetting the bond market, to the more recent example of Liz Truss's short-lived premiership in the UK, which was marked by a disastrous budget announcement that sent bond yields soaring. As governments around the world grapple with rising debt levels, the bond vigilantes are becoming increasingly powerful. With global government debt standing at around $100 trillion, investors are growing nervous about the ability of governments to service their debt and are seeking safer alternatives. This has led to a surge in demand for bonds from countries like Germany, which is seen as a more stable and fiscally responsible borrower. The implications of this trend are far-reaching, with potential impacts on everything from mortgage rates to bank profits, and even the ability of governments to fund essential public services. In the United States, the bond market has been watching President Trump's policies closely and has been particularly critical of his tariff announcements. The similarity between Trump's situation and that of Liz Truss has raised questions about whether the U.S. could experience its own version of the Truss lettuce moment, where the bond market forces a government to reverse its policy. While it is unlikely that China, which owns a significant portion of U.S. debt, would use its holdings as a tool to exert pressure on the U.S. government, the bond market remains a powerful force that cannot be ignored. As the global economy continues to evolve, the role of the bond vigilantes is likely to become even more significant. With central banks like the U.S. Federal Reserve having tools at their disposal to influence the bond market, the interplay between governments, investors, and monetary authorities will be crucial in shaping the course of economic policy. One thing is clear: the bond market will continue to play a critical role in holding governments accountable for their fiscal actions, and those who ignore its warnings do so at their own peril. As warnings from the bond market grow louder, it becomes increasingly clear that the Trump administration is facing a critical juncture. The bond market, a key indicator of economic health, is sending warning signals that cannot be ignored. The comparison to the UK's recent turmoil under Liz Truss serves as a stark reminder of the potential consequences of unchecked fiscal policies. The analyst's assertion that the US has more room to maneuver than the UK is a double-edged sword. On one hand, it suggests that the US economy is more resilient and better equipped to withstand shocks. On the other hand, it implies that the Trump administration has a greater responsibility to act judiciously and address the concerns of bond investors. The specter of spiking yields looms large, threatening to undermine the administration's economic agenda and potentially derail the country's long-term growth prospects. But perhaps the most insidious risk is the erosion of trust in the U.S. as a reliable and trustworthy economic partner. Once lost, trust is notoriously difficult to regain, and the consequences of such a loss could be far-reaching and devastating. As the world watches with bated breath, one thing is certain: the Trump administration's handling of the bond market and the economy will have far-reaching implications, not just for the U.S., but for the global economy as a whole. The question on everyone's mind is Will the administration heed the warnings and take corrective action, or will it continue down a path that risks undermining the very foundations of the U.S. economy? Only time will tell, but one thing is clear: the stakes have never been higher.